Brothers and sisters, ladies and gentlemen, apes and apettes, welcome back to the channel. If you guys didn't see the title of this video, and if that didn't give you a glimpse of what's going to be in this video, well, this week is going to be a total shit show. Not necessarily in the sense of we're going to drop to new lows, which we'll talk about the possibility of that happening, but the markets are going to get a lot of data and a lot of information. So this will spark something very negative or spark something that is very positive. And now we can use our best judgment, our years of investing experience and knowledge to play a role into how to position our portfolios to make the most of this shit show week. And that's what this video is here to do. So that's all you get for the intro. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. But most importantly, let's get straight into it. So on Friday, a brief rundown of what happened last week. Essentially, you had interest rate probabilities go up through the roof. Last week, starting Monday, Tuesday, we were not expecting a 75 basis point rate hike, a very low chance of getting that. Now it is 100% certain we are at least getting a 75 basis point rate hike. If not, a 15% chance we are getting a 1% rate hike on Wednesday. That is September 21st. The Fed at 2 p.m. will raise rates. At 2:30 p.m. Fed Jerome Powell will come out and give his speech. Now, we will talk about that more extensively here in this video in just a minute or two. But what else happened last week? We seen FedEx earnings come out, and they were terrible. FedEx cut guidance for the year. They said the whole globe is going into an economic recession or possibly a depression. That was not good. That really helped to snowball the drop in the stock market we've seen over the last week. And what happened on Friday, the stock market did close down about 0.76%, but there was quite a sharp rally about halfway through the day. We bottomed out at 382.11 on the S&P 500. And then we did rally about 0.5% in after hours. So that was a good thing to see that recovery towards the end of the day. But I wouldn't get too far ahead of ourselves. We haven't seen anything yet. The real data information will come to us this week, mostly with the Fed. And where I want to start this whole segment of the Fed in this video at least is by saying the markets don't necessarily care about if the Fed's going to raise 25, 50, 75, or 1%, right? They don't care how big the rate hike is. The markets care about how long are the rate hikes going to last? How long is it going to be until the Fed cuts rates? Forget the size of the rate hike. Does not matter in regards to what the market's going to do. It matters if the Fed's going to cut rates or slow down those paces of rate increases. What I mean by this, to put this into context, who gives a shit if the Fed's going to raise 25 basis points for, 5 years, right? Every meeting, they're just going to keep raising. That would be very bearish, even though it's a small rate hike. Well, if the Fed raises rates, just say 5 times at 1%, well, and this is not happening, right? This is all, a concept trying to prove a point to you guys. Well, the markets would probably like that a lot more because you would get to that terminal rate and then you have a greater likelihood of the Fed cutting rates. And a lot of this decline that we have seen in the stock market over the last couple of weeks, over the last 2.5, 3 months now, has been because the markets and the bond market specifically, that is much larger than the stock market, which stock investors look to the bond market to say, hey, what are you guys thinking, right? Because the bond market's so big, there's a lot more information, so on and so forth. Bond market's usually right. Well, the bond market was pricing in rate cuts in 2023. Now, we're not pricing that in due to what the Fed has said, due to inflation that continues to go higher. And that's the big thing. That's what has caused all of this downside. And the information that we get on Wednesday at 2:30 p.m. when Fed Jerome Powell comes out and speaks is really going to set that home. I think he's going to portray a message to us that potentially they're not going to cut rates, but they will stop raising rates eventually, or at least slow down. What I mean by that is the Fed's probably going to get to 4.5% federal funds rate, and then they're going to slow down raising rates. So let's take a look at where the federal funds rate is right now and where it'll be after Wednesday. So the federal funds rate right now is at 2.5%. Well, coming September 21st, you're probably going to see the federal funds rate at about 3.25%. Some Fed speakers have said they wanted to see the rate at 3.5%. Some are saying 4%. Let's just say 4.5% because inflation has been getting so high. That means the Fed will have to at least raise 1.75 basis points, 1.75%, before they stop raising rates, right? To get to 4% or 4.5%, be a little bit more than that, right? Doesn't necessarily matter the exact number here because we don't know the exact number. Anywhere from 3.5 to 4% is what they say. They'll probably go more than that. That's why I said 4.5%. Well, that means if we get a 75 basis point rate hike, that puts us at 3.25%. Or if we get a 1% rate hike, that puts us at 3.5%. And then it's only going to take one rate hike to get to, one more 1% rate hike to get to 4.5%. The markets might actually like something like that. The markets might actually like this whole front-loading rate hikes, getting us to that level, that neutral level, that level that we want to be at, that terminal rate, not neutral rate, terminal rate. The Fed wants to get those rates to and then hold them there, because usually if the Fed gets us to a place and holds rates there, eventually they will cut rates. And in theory, that lagging effect you see with monetary policy might actually help you 3, 6, 9, 12 months down the line, and might not be as restrictive once people actually get used to the policy. So as of right now, guys, I'm not going to say we're going to be super bullish, super bearish. We have dropped a lot heading into the Fed, so that is something that makes me instinctively bullish. But right now, the market's PE is still at about a 19, and the 10-year average for the S&P 500 is about 16.9. So call it 17 for a PE. So you're still overvalued on a basis relative to the last 10 years. So believe it or not, you've seen a lot of pain in your portfolios, but stocks are still overvalued in the grand scope of things. Not a lot of stocks. A lot of stocks are undervalued, grossly undervalued, but some of those large market weightings, your Microsoft that has a 27 PE, right? Your Apple that has a 26 PE, some of your other companies that have higher PEs, that's what really skews those price earnings ratios on the S&P 500. But nonetheless, you've dropped a lot heading into the Fed. So I think Fed Jerome Powell, and this is a big I think, this is not a recommendation, but I do think Fed Jerome Powell will indicate that they're not going to cut rates anytime soon. But like I said, they will stop raising rates as aggressively, and that could be a bullish thing for the stock market. And that's the big thing for this upcoming week. Other data points include on Tuesday at 8:30 in the morning, you have housing starts for August. 8:30 in the morning as well, you have building permits for August. And that's pretty much it for Tuesday. You don't have anything on Monday. On Wednesday, you do have existing home sales for August. That comes out at 10 o'clock in the morning. And then at 2 p.m., you see right here the Fed interest rate decision. 2 p.m. as well, you do have the FOMC economic projections. And then at 2:30 p.m., you have the Fed press conference. And that's pretty much it for Wednesday. For Thursday, you have current accounts for Q2, initial jobless claims for this week of September 17th. Nothing too crazy. It's probably not going to move the markets in a big way. We'll see. We've been surprised before. And then on Friday, you will have Fed Jerome Powell that speaks again at 2 p.m. So whatever he says on Wednesday, he's probably going to hammer that narrative home by Friday. If it's bullish, if it's bearish, we'll get more information. Now, I will say Fed Jerome Powell does not want the stock market to go up because that hurts their goals of fighting inflation. So keep that in mind. The Fed is not your friend. They're not trying to get stocks to go up. They don't want to see your portfolio go up in the way that it has over the last couple of years, right? You shouldn't get 20-30% swings in certain names or 5 to 15% moves in the index on a monthly basis almost every single month. That should not happen. The Fed does not want that to happen, but they certainly don't want those swings to be to the upside like we did get over the summer. And I think that's why the Fed has been so hawkish over the last couple of weeks, is because that rally that Fed Jerome Powell sparked himself by saying that they would inevitably slow down their pace of rate increases and then stop raising rates in general. So there is all that information, and I just threw a lot of it at you guys, so feel free to watch this video again, because to hear this twice is not a bad idea. Now, if we take a look at AMC stock, you have a cost to borrow average of 18.15%, cost to borrow max of 19.52%, and cost to borrow minimum of 16.4%, $1 billion worth of short positions on AMC, an estimated short interest of free float at 19.67%, a free float out on loan at 37%, and days to cover at 4.25, still at a 100% share utilization. And if we look at the option activity for Thursday, or really for Friday, you had 8% positive order value, 13 orders totaling $7.19 million. So you had a lot of puts coming through for a lot of money. Some of these for October 21st, $15 put for $3.2 million. Another October 21st, $15 put for $3.17 million. You know, those are orders that are so big they will move the stock. And it is a amuse to me, whatever word you want to use, that AMC did not fall more on Friday given those options that we've seen alone. $3 million on a single option trade, two of them in a day, to the put side or to the call side. You don't see that. And even on bad days, like 15% negative days, you still don't see that kind of option activity. So the fact we only went down about 9%, it's not terrible, but yet we did break under the 100-day moving average, so we did not find support at that level like I was hoping for, but it does look like we did find some support around that $9 level. We did close at $8.98 per share, down 9.11% for the day, and you did pop up 12 cents in after hours, so you did close at $8.10 per share on Friday, which is very, very good. Or did I say $8? I meant $9.10 per share. So that is very good in my personal opinion. The RSI is at 42.63, so also still on the oversold side, and the MACD is slightly bullish, but after Friday, once we get to Monday, the MACD is probably going to look pretty bad yet again. Now, how does all of this Fed talk, how does all of the AMC talk really play into how AMC performs on a chart? Well, let me tell you this. If the markets are bullish, AMC is going to be egregiously bullish. If the markets have a 3% positive day, AMC is probably going to have a 15 to 25% positive day. Because why? It's a riskier asset, a risk on asset. And when the Fed talks about, you know, something bullish like slowing down raising rates or something along those lines, those riskier assets are going to perform very, very well. Now, if we get a negative market reaction, well, it's going to be a complete shit show for AMC stock, for a lot of these stocks in our portfolios. Now, what do you do about this? Well, you don't want to sit on your hands and just watch your portfolio, you know, go down the drain. But you don't necessarily want to risk it for the biscuit, because in 2022, you've seen nothing normal about the stock market, about AMC, about any of these stocks and how they react to major catalysts. What I'm personally going to do is probably going to wait until the press conference at 2:30, because it's going to be, you know, late market. You're still going to have a chance to play the reaction after the Fed. And believe it or not, you might get a lot of better deals on some of the premiums or even buying stocks, whatever the case is, after the Fed, and you will be able to see which direction things are likely to go, right? If the Fed talks about slowing down raising rates or stopping raising rates, I don't care if the markets fall 3% that day, I'm buying calls, right? Don't matter. It matters what he says, not how the markets react. Now, if the Fed says there's no way in hell that they're going to cut rates or slow down raising rates anytime soon, well, that's going to be a big negative. You're probably going to want to get yourself some puts. Not financial advice. I don't know what's going to happen. I don't know what he's going to say. Don't listen to anything you hear on a YouTube video. Come to your own conclusions. Ladies and gentlemen, that is going to be all for this video. Threw a lot of information at you guys in a very short amount of time. So, for all of that, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock down below in the description with Webull, Moomoo, and Public, as well as that if you guys want to come trade with me live in real time, link down below in the description as well. Thank you for watching, and I will see you in the next one.